Hello, welcome to another episode of the Capital Employed podcast. Joining me in conversation for this episode was Barry Norris from Argonaut Capital. In this episode, Barry talks about his investment style and strategy. He also walks us through his thesis for investing in two companies which he is very bullish on. I really enjoy listening to him, and I think you will too. Before we jump into this episode, do make sure to add your email to the Capital Employed email list. We will be publishing some exclusive interviews that will only be available to those on the list. To receive these bonus episodes, please visit capitalemployed.fm/exclusive and add your email to the list. If you are listening to this podcast on the Apple Podcast app, please do feel free to leave a review. It helps us spread the word, and the feedback is great too. Okay, on with today's episode. Please enjoy my conversation with Barry. Hi Barry, thanks for coming onto the podcast. Can you provide an overview of the Argonaut Absolute Return Fund? What is the objective and the investment style?
So the fund is aimed at investors who want diversification from market direction or beta. So we assume that our investors will have other stock market investments and indeed encourage them to do so, either in active funds or cheap passive beta. And what we're trying to do is to deliver double-digit uncorrelated returns, which will blend very well with these other assets because we produce returns at different times and therefore improve the overall risk characteristics of the wider portfolio. So obviously, a massive trend in our industry has been passive funds, the ability of investors to buy cheap market beta exposure, and also, of course, DIY investing, with people liking to research and invest in stocks themselves. So what we do is to just provide something different to that. And obviously one of the main way that we provide an uncorrelated return is our ability to short stocks as well as long positions, and for those short positions to provide a market hedge which generates a return profile which is uncorrelated.
Did you find this approach worked well over the past year with all the pandemic crisis?
Last year was a fantastic illustration of the benefits of a non-correlated fund, because in this time last year in March, the market fell 20% in a single month. We had a record 15% up month. And I think that demonstrated the folly of diversification with only long-only funds or long-only stock positions. You know, we certainly don't want to be negatively correlated to the market. And indeed, in March last year, we were actually still net long the market when we delivered that return. But that, if you like, was the best example I can give of why it's important to have investments and funds which can provide returns at different times to everything else that you own.
And these short positions, are they targeted at individual companies or at the market as a whole, if things were to get overvalued perhaps?
Yeah, so all of our short positions are individual stocks. We don't really believe in hedging through index options. So we aim to add alpha on the short side as well as the long side. So we call it double alpha. You know, in general, there's three types of shorts for us. One, frauds, which are very stock specific. Two, overvalued growth, which are, investment bubbles that hopefully we go short fairly near the top of those investment bubbles. And finally, value traps, which tend to be in sunset industries where the business is in a secular decline. I would say I wouldn't encourage any individual investors to short unless they have a specific edge and proper risk controls. We do it obviously for return, but also for our uncorrelated profile of our investment return. And I think it's also very important to be pretty well diversified in short positions. So our short positions are typically much smaller than our long positions. We make sure that we are pretty widely diversified, simply because the short profile of or the profile of shorts can be somewhat different to that of our long positions.
And for your long positions, for the equities, what type of businesses do you like to invest in?
Our investment style is to look for earnings surprise. So whereas most fund managers will characterize their investment style as value or growth, we believe in something which is a little bit different, but which we believe is actually the determinant of the stock price, which is the earnings profile, how much profit the company is going to earn. And specifically, when a company earns more profit than the market thinks, then the share price goes up. And when a company earns less profit than the market thinks, the share price goes down. I've been investing now or running funds for over 15 years. So we've seen a number of different cycles. There was very much if you like, a value cycle from 2000 to 2008. Then since the great financial crisis, you've seen growth stocks largely outperform. And of course, growth managers over the last 10 years will tell you that's because growth stocks always outperform. And value managers in the previous cycle said the same thing, whereas we would argue that actually that this style bias, if you like, is very much determined by earnings. And when if you like, there's a lot of economic growth around, average stocks can grow their earnings, then valuations are important. But when you're in a low economic growth environment, as we've been since the great financial crisis, interest rates are very low. People can think longer term about their investments because inflation's not an issue. That's the type of environment where growth stocks do well, and obviously particularly disruptive technology stocks have led the way. And that's because growth has been scarce, and therefore investors have been more willing to finance new business opportunities. So, I think it's very important to think about the fact that biggest risk that most fund managers face is actually their style risk, that simply the market doesn't reward cheap stocks, or the market doesn't reward growth. We think that we have a process which better allows us to navigate that. But of course, I would say it's probably much more difficult to identify genuinely earnings surprise than it is to identify a cheap stock or a growth stock. We very much think that the process works much more consistently, but it's certainly not idiot proof.
And what would cause you to sell one of your positions?
There's a portfolio construction aspect in all what we do. So if we find better uses of our capital, or we're taking profits, typically most of the time we buy and sell a stock is for portfolio management. What we are looking for is an idea which we've obviously done our research, believe that the company is going to earn less money than the market thinks, and that there are catalysts in the near term for that to play out. On the long side, most of our selling, if you like, will be in stocks that we think of the idea either hasn't worked out as we expected. And I think, as a fund manager, the longer you're in this business, the more humble you are about, the fact that you're not right all of the time. And we've got better uses of that capital going forward.
Okay, so can we take a bit of a dive into your portfolio? Can you talk us through maybe two companies that you're very bullish on at the moment? And what was the thesis for investing?
One of our biggest positions at the moment is in Porsche. Also, by that, we also mean Volkswagen, because Porsche is basically a holding company for Volkswagen. So we're buying Volkswagen shares at a significant discount to net asset value of roughly 40%. Why is it attractive? Well, I think until recently, investors have thought that the move to electric vehicles was going to be a trend which solely benefited one company, and that was Tesla. And that Tesla obviously has been a technological leader. It hasn't had a legacy combustion engine business, and that Tesla was going to dominate in the same way as Ford dominated in the early part of the last century with the Model T. I think it's become a lot more clear that actually the market has significantly underestimated the efforts of traditional car OEMs, and specifically Volkswagen, which through its ownership of Porsche, Audi, obviously Volkswagen itself, and a number of other luxury brands like Bentley, has actually got massive R&D budget and is able to amortize that over a number of different models. So I think what we will see over the next 18 months is actually the Volkswagen Group sell as many electric vehicles as Tesla, whereas previously I think the market viewed traditional OEMs as losers from EV. It's become more clear that actually EV will be more profitable than combustion vehicles, and in the long term, Volkswagen will generate sales from very high margin navigation software in the same way as the market expects that from Tesla. And whereas, if you like, Tesla trades at a valuation which is very difficult to think is cheap in any way, even in 5 or 10 years' time, Volkswagen is still trading on a single-digit price earnings multiple with significant net cash on the balance sheet. So we certainly believe that as we move to EV, which I think is a process which is certainly going to be accelerated because of the economic stimulus that post-COVID governments have thought is now desirable, that Volkswagen and Porsche, by its virtue of being the cheap way into Volkswagen, will be a great investment over the next few years.
Okay, and how about a second stock you're quite bullish on as well?
One of the sectors that we are very bullish on at the moment, and have been since for the last 12 months, is semiconductors. And obviously, semiconductors is a great secular growth industry that's been accelerated by COVID and digitization, and the fact that it's also the most cyclical part of tech. And at the moment, we have booming, or will have booming, economic global growth this year, and there's supply constraints all along the industrial complex. And at the moment, we want to be in the most commoditized area of semiconductors, because that's where we think the greatest upside is in terms of price inflation. We also want to be in stocks that we think are potentially going to benefit from industry consolidation, because we think that will continue. Our biggest holding in semiconductors at the moment is in a US company called Western Digital, and this is very much involved in data storage, and specifically the bit that we like about it is in its exposure to NAND, which is basically memory. And there are two types of memory. There's DRAM and NAND. The DRAM market is slower growing. It's being consolidated with only 3 main players. As a result of that, pricing has been very good. We think the next thing to happen will be that the NAND market gets consolidated in the same way. So we think there's going to be significant consolidation in that industry, and we think that Western Digital will be part of that. We think it also benefits from significant price increases in commoditized semiconductors where its business model is based. So we think that this is not in the current share price, and that if the NAND market consolidates in the same way as the DRAM market has, then there'll be significant upside for Western Digital, either because it gets bought or because it benefits from consolidation in the rest of the industry.
Yeah, I've heard reports that the US government want to bring back much of the production of semiconductors because it's so important. I just wonder if Western Digital will, really benefit from that too.
I think what the US government would like US semiconductor companies to consolidate and buy, obviously, assets. And there is a issue at the moment in that, obviously, any consolidation which involves an Asian company buying a US company is seen as problematic, and similarly probably the other way. So, we believe that Well, at the moment, Toshiba, which is a big player in NAND, Western Digital, and Micron are probably likely to consolidate together. Toshiba being obviously Japanese, and we see obviously that as something that the US government will be obviously delighted to encourage. But it's certainly true that if you look at the geopolitical angle, the US is very, very exposed to Asian production, and certainly if something were to happen in Taiwan with China, that would be obviously a significant geopolitical issue.
Okay, Barry. Yeah, thanks for sharing your thoughts on those two businesses. Where can listeners go to find out more information about you and Argonaut Capital?
Sure. So we have a website, Argonaut Capital. We put a lot of information on that. You'll find monthly fact sheets. We write a regular blog called Argonautica, where we publish our views on investments, and we roughly write once a month, although we hopefully only write if we've got something interesting to say. We're also on YouTube, where we put some videos out of our funds and on timely issues, and we're also on Twitter as well.
Okay, that's great. Yeah, thanks so much, Barry, for coming on. It's been a pleasure to listen through your investing style.
Pleasure.
Okay, thanks so much.
Cheers.